Well, there's a lot going on in the U.S. A lot of confusion, a lot of disruption, obviously new regime, new administration, a lot of animal spirits out there, but also a lot of worries. What we're trying to do is sort through it in a way that makes sense to keep investing. We're a property investor. You have to invest in the market you have. You don't get to choose those conditions. You don't get to choose when things are stable or supportive. Wherever you find yourself, you have to look for the opportunity. We've just gone through a really interesting cycle in the United States, property cycle. Property values went down for 2 years, quarter after quarter after quarter. It happened for the first time ever without a recession. That's a really strange thing. That's never happened in the United States before. What happened was interest rates changed a lot. Federal Reserve raised interest rates 500 basis points to attack inflation. Property yields had to move with that. That brought values down. So we're at the end of that now. We've just had 2 quarters in a row where values have started to move back up. Presumably, the Fed is moving towards lower rates, not higher rates, but there's a lot of uncertainty around that as well. So when we look at the U.S. property markets, we're looking for places where we can invest and make good returns for our investors, regardless of what happens with interest rates. We can't count on interest rates coming down again like they have most of the 15 years since the financial crisis. So what we're doing is really a back to fundamentals real estate investment approach, finding the right property in the right sectors, in the right market, but more importantly, doing old-fashioned real estate asset management on those properties. Roll up the sleeves, keep the property full, control your expenses, be really thoughtful about the capital you put in. Make sure you're making a return on that capital. Don't just put new marble in the lobby because it looks nice. Do it because it's going to get you a better tenant. And grow the income. I tell the young people at my company all the time, the only thing you can control is growing the income. You don't know how the market's going to price that income 5, 10, 15 years in the future, but I can guarantee you if you grow the income year in and year out and demonstrate to the market that it's stable and able to grow, eventually the market will come to you and reward you with better pricing. Today we find those characteristics in a few key places. The one we're leaning in the most to today is senior housing, assisted living, memory care, property sectors like that. I said there was no recession, so you can't really count on cyclical recovery in most sectors, but the senior housing sector just went through a period during COVID that looks and feels a lot like an economic recession. So we're seeing cyclical recovery in occupancy and in rent, real recovery in value going on today. That's today, that's over the next 2 or 3 years. But what people lose sight of is that's just about to run into our baby boom generation, 70 million people born between 1946 and 1964. The very leading edge of those start turning 80 in 2 years. And every year for the next 20 years after that, we have about 4 or 5 million people in the United States turning 80. That's the age when people start looking at these properties. So cyclical recovery dovetailing into the strongest tailwinds for a property sector that I've seen in my 35 years at AEW.